Hey, it's Slade. This is episode 613 of the Orange Pill Investor. And today I'm going to talk about the IPO for SpaceX and its potential for being a binary event for Tesla investors. This was by special request from Johnny Poker Asia. And just a quick note, practice some OPSEC, man. You can't put your location and your handle. People can find you. They might just head over to Asia and track you down. But I thought it would be a good topic to discuss. In general, the most relevant binary events are earnings calls. I think that's pretty well known. But even things like there's a superstition around the Bitcoin conference every year, and Bitcoin's price tanks over the conference. I think it happened again slightly over the past week, and now it's coming back to life. But the question is, shit. This was him giving me some help on my Tasty Trade setup, which I couldn't believe I had actually already set up. Here it is. So listen to Invest Answers today about a possible Tesla dip leading up to the SpaceX IPO next month. Could you discuss whether it would make sense to start selling weeklies close to at the money to capture this? I listened to that episode, and guy is pretty good. I think the only thing that I had to complain about is I think he said something about rotating into B-Sol, which I think was something around something. Was that related? Something related to Solana? If I misheard him, then I apologize. But he does seem to be very pragmatic and shit, not atheistic. What is it? What is it when you don't hold any particular love for any position and you're willing to just anyway? Doesn't matter. It was definitely a good show, so I appreciate the recommendation. And so let's talk about it. The possibility is there. I guess a quick side note, I think for most Tesla investors, I think it would be pretty stupid to rotate out for this IPO for some of the reasons that Invest Answers said. Like, he kind of felt like SpaceX was a little bit overvalued for this IPO and Tesla was undervalued. So it would actually make more sense for SpaceX owners to divest some of their position into Tesla. But the companies are going to merge in a couple of years anyway, probably after Tesla's market cap pumps from the Cybercab profits and rollout. And so I think Tesla investors that want exposure to SpaceX can just do nothing and just wait, because eventually you'll have some shares in SpaceX because there'll be one company. But for the people who can't wait, could enough money rotate from Tesla into SpaceX? I think it's a very real threat. But selling the weeklies, I don't know that that necessarily works except once, because when you have a binary event, you have to take a position before the event, and then the goal would be to exit that position after the event and capture the difference. Hopefully if you're taking a covered call position, then you would sell it for a certain amount and then buy it back for cheaper after the event. And if you're selling a put, same difference. You would hope to sell it for a large amount. The IPO happens, and then there's less of a reaction in the market than the market anticipated, and then the option is cheaper to buy back. Now, you could continue to sell weeklies if you wanted to try to time the dip. And let's see, Grok is saying potential June. So if you thought that this dip in price could last 2 weeks or a month, I suppose you could try to like time it just right and sell covered calls during that portion. But I think it would, and we really don't even know when the exact IPO is, right? Is this a, do they even tell you exactly? Is it ever going to become um, known in advance, or did they just surprise us? Surprise, surprise, bitches! We IPO'd today. I suppose that we should get um, an exact date at some point, right? So, in that sense, I would probably sell the option. I would take the position as close to the IPO as possible, as close to right before the IPO as possible. And even then, people might start. You know what? I wonder if there's people who would be selling off their Tesla position a month in advance and then waiting to buy the dip. And I say a month in advance, like just in case they were selling at a loss, they could tax loss harvest without getting hit with the wash sale rule. So if there are people that are upside down in their Tesla position, could they be selling now just to buy the dip later? Or selling now to put into the SpaceX when it comes out for maybe a quick flip, and then if SpaceX runs up, they sell that to jump back into Tesla. Who knows what these fucking people are thinking? But I would treat this the exact same way that I do earnings. So earnings for strategy, use that as an example. Strategy's earnings call. Let's make that a little bit bigger. Let's get rid of this. I would take, if I was going to do an earnings play for strategy, this is going to be after market close, and I would take this position tomorrow, sell a cash secured put, sell a covered call, sell a credit, put credit spread, sell a call credit spread, sell both and turn it into an iron condor. Any short position, any short vol position would do that. I mean, and then if there's no big reaction in the market, then potentially you would be able to buy these back cheaper when the market opens on the 6th. I guess I'm taking a tangent here. I really don't think that's a good play because you can just see, this is market chameleon. You can see that strategy doesn't really have a lot of anticipation before earnings. I think that's because their Bitcoin buys are so transparent. Like there's no run up in implied vol ahead of earnings like you would see for something. Let's see if Tesla's a good example. I guess this one is not bad, right? We had IV crush after earnings, it stayed low, and then halfway to the next earnings, it started to creep up again. Call this a crush. It's not that big, but I don't know why. I guess maybe because Tesla's price was dropping this whole quarter. I think. I don't know. IV didn't really crush and go back up, so this is actually a terrible a terrible example. Let's look at something that might. Let's look at let's look at Nvidia. That one should be very earnings call dependent. Okay, perfect. So IV crush, it's crushed. Surges before earnings crush. Surges to earnings crush. Earnings to earnings crush. So this would be a perfect earnings play. But strategy doesn't look like that. And Tesla looks less like that. It's not like there's little crushes here, but it's really not pronounced. But the point is, I would, if I was going to treat this like an earnings play, I would take a position as close to the earnings as possible and take it off as soon as that event happened. This one is a little bit harder to figure out because it's like, okay, well, how long will Tesla's price stay dipped? And this is just assuming that the price will dip. The basic assumption on this is that Tesla holders will take some money out and diversify into some SpaceX positions. And if that is true, then yeah, I would take some kind of, I guess, a covered call position ahead of that date and then just close it as soon as possible for a profit afterwards. And so that's really just like a one-time thing. And I don't know if you're selling regular covered calls on Tesla to begin with, but you could even, Tesla has 3 expirations a week. So you don't even have to do a 45 DTE. You could just put this on for like 2 or 3 days. You wouldn't even have to put it on for a week. If you think Tesla's price could stay dipped for 2 weeks, could you, sell weekly at the money, just pretty aggressive? You could make about almost 2% of the underlying value per week doing that. But this is for 4 days, $730, right? Yeah. And doing it to this Wednesday, you can get $500 for 2 days, and then presumably this would still be worth $500 from Wednesday to Friday. That's $1,000 instead of 700. So if I was just going to do weekly ATM, I would say fuck it, and I would just sell these 3 times a week. And then I think from Friday to Monday, you don't really get much. You might get half to 0.75% of the underlying price. Like you might get 200. You might get $200 to $300 from Friday to Monday. I can't remember, but that would be like $1,200 a week instead of selling the actual weeklies and getting $700-800 a week. You do have to caveat that by, if you're rolling from last expiration to this, depending on what time of day you do it, there's still $150 here. So if you got paid $250 on Friday and you want to roll this, you're actually only capturing about $80 of that, $70. And so that's only like 0.25% of the underlying value from Friday to Monday. And then if you're capturing $550 for Wednesday, but you just paid $175 to roll, you're only keeping what? Maybe about 1% of the underlying, and then another percent. So it's still 2.5% a week of the underlying price. So this is not bad. It's a very good premium that you can capture even now. So it's definitely doable. But yeah, if I was going to go super aggressive and sell the weeklies, I would just say screw it and sell them 3 times a week for however long you think it's going to dip, 2 to 4 weeks, or 1 to 4 weeks, or just completely treat it like an earnings play. And if it ends up being June 5th or whatever, then on June, yeah, if it was going to be like June, well, if it IPOs on June, let's just say if it IPOs on June, yeah. Yeah, if it IPO'd on June 5th, then I would take this position on the 4th before the market closes. And then on June 5th, it IPOs and this expires, and then I would just take it off. I guess if it was like midweek, or if it was like June 8th, didn't Grok say something about June 8th? Roadshow week. So they're already having an event planning an IPO roadshow for the week of June 8th and would typically lead to pricing and trading in the following weeks, so possibly mid to late June. Okay, so it's going to happen. Let's just say it happens June 8, June. Well, we're going to start getting weeklies built out. But let's just say let's just say that it's going to IPO June 15th. You'd have to take out a June 18th position on the 14th. And then if the price of Tesla crashes after that binary event, then you could buy all those positions back cheaper or let them expire potentially and capture all of it. But the question would be like if SpaceX IPOs on the 15th and the price does dip, like how long does that dip happen? I think it would probably be very transient. And I think Invest Answers felt the same way. Like, hey, it's, if it drops 10%, that's just a buying opportunity for Tesla. It's not like, so I guess you could sell the calls and then if it dips, you could buy shares on the dip. That would be a nice combo. Be a nice way to capture some premium and then close the position, keep half the money, put those into more Tesla shares at a discount if it works. But something like that is the way that I would play it. That would probably be the safest way to do it, is just to do this, make it like a one-time thing. But if you're used to selling covered calls on this all the time anyway, and you're just talking about doing like a temporary aggressive at the money type thing, you could do the weeklies, but I would probably just go balls to the wall and sell them 3 times a week for however long you think you can get away with it. And almost 100% chance to be wrong. I was kind of hoping that I would time it just right with strategy. And it worked for a couple of months. But I'm still trying to unwind these bad boys. Looked like I was going to get a chance to close these out. Wait, that's only one. What's the other 10 of them? That was just Tesla anyway. Good Lord. These guys. I'm still sitting on the 160s. When strategy was down to 165, 170, I was like, oh, okay, I'm going to get a chance to unwind these bad boys, but it's going in the other direction again. But also, big thanks to Johnny Poker for reminding me about extrinsic value. I actually had it over here, so he gave me the instructions on how to do it, and I was like, oh yeah, I can't believe I haven't been using this. And I was like, fuck me, it was over here. The extrinsic value was over here. And like every time I'm going through these damn videos, I'm calculating the extrinsic value. I guess it's good to know how to do it, but old people, man, what are you gonna do? Yeah, so this will save a lot of time. And so just for an example, if I wanted to calculate this, I would subtract 160 from 183. That's 23 bucks. 23 from 28 is 5. Oh, this is giving me the extrinsic value for the entire position. That sucks. Is there an extrinsic for extrinsic rate of return? Extrinsic per position is what I would really like. Okay, maybe not. Yeah, so what did I come up with? $5. And this actually is easy math because it's 10 contracts. So there's $474 of extrinsic value out of this 2,800. And that's not terrible, but it's also not Let's see, $500, 25 days. That's about $100 every 5 days. 3.5 weeks, 3.5 trading weeks. Yeah, it's about 170 per week. So that's not terrible. If I wanted to try to roll this out to 45, the bid-ask spreads are not the greatest. So if I only rolled out to 39 DTE, or yeah, ugh, the bid-ask spreads are just as atrocious here, $5 wide. That's god awful. Yeah, I might just hodl this thing and try to turn these back into weeklies again if I get the chance. Actually, these are already rolled out to May 29th. Actually, that might work out perfectly because if the sell in May phenomenon works out again, and it's going to be real interesting to see what strategy does after earnings. Like, I don't think there's any earnings surprises. Everybody knows how many Bitcoin they bought, how many Bitcoin they own. But I wonder if some investors could be using this as a sell signal, like, all right, strategy's up recently over the last month or so. Maybe I'll take some profits on earnings if I don't hear any amazing news. Um, oh, but a quick note on Tesla's implied vol. It's not really very high. The premiums are fine. And so sometimes IV rank, sorry, this is IV rank too. It's not actual IV vol, implied vol. But this is compared to the last 365 days of IV and then ranked accordingly. And so compared to other days, this isn't very high vol, but that kind of doesn't matter as long as there's a good amount of premium, and there is. So I think that the Tesla trade is viable, and this number can kind of be ignored. I mean, Tesla's implied vol is basically been just tracking horizontally. So it's not Tesla definitely isn't feeling any anxiety about this event yet. Once the date is identified, maybe watch this chart and see if implied vol starts to spike ahead of that date. Like if it seems to spike ahead of that date, there's no reason for it to be spiking this early for the next earnings date. So if it does start to climb, it could be because there's some anxiety around the SpaceX IPO. And in that case, that might bolster the thesis for trading around it. But if this doesn't really spike, I mean, I think there's still enough premiums in the position to do it regardless, but this could just, I guess, instill a little bit more confidence that there really is a trade to be made around this event if we see some implied vol spike for no reason. Um, Actually, this is a pretty if sell in May and go away does happen and Bitcoin comes down and a lot of the stock market comes down, or they decide to tank the markets so that they can justify a bigger interest rate crash, or who knows what kind of shenanigans they play in the shadows. I'm already short as fuck on this position, so maybe I just hold on to this 160 and maybe the price just comes back down to earth anyway. That would really suck. um, but towards the end of May, if the price is still at 180, I might just close one of these positions. That would give me 15 grand. And then I could use that to pay to close the other 10. Well, I've already got this one back down to a weekly. Actually, it's still underwater. So the other 10, if we're still trading, yeah, that would actually be almost perfect. I would need about 20 grand to roll these down. Excuse me, to roll these to the at the money price. Actually, I wouldn't even bother. If I think the price is going to go down over the summer, I wouldn't even pay to roll these up. I might just take that profit and put it into something else. Put it into a Tesla position, potentially. I don't have any Poorman's covered calls in Tesla, and that would cost me almost probably 20 grand. So that might work. What would a Poorman's covered call in Tesla cost me? And actually, that would work out perfectly if I set aside some dry powder, and then in June Tesla dips by 10%. That would be a very good opportunity to put on a Poorman's covered call, hoping that the price comes back. But anyway, at today's prices, let's hit almost, let's do 84 delta. That's, add those together, that's 416. So I would have to hit this. Yeah, that's perfect. I'd capture about 15 grand selling off 100 strategy shares. I would take some profits on a recent time frame. That would actually be some tax loss harvesting, because I think my trade price on strategy, can't remember, it's at least in the 300s. And then I could put this together and cost me 15 grand. That's almost perfect. So if Tesla's still holding up like a champ at the end of May, maybe I will close one. Yeah. Get a 15 grand credit, put a Poorman's covered call together for Tesla for about a 15 grand debit. That sounds like a plan. I'm going to have to put that in the back of my head and remind myself to do that. It's funny because Radu's been calling August 3rd Bitcoin price of 50K, which would put strategy sub 100. And it reminds me a little bit of when Josh Mandel had that insane call of, was it 84K or something ridiculous on Bitcoin. And unfortunately, the 444 rebound hasn't worked out for us, but eventually it will. But people are asking Radu, like, what is he basing it on? And he's kind of basically just like vibes. He basically has like a feeling or some kind of intuition for it. And I almost kind of feel like that's a better trade indicator than all this fucking TA people do. Oh boy. So I won't be doing anything that dramatic like buying puts or debit spreads or anything like that. But I may be hammering the covered calls pretty fucking hard. It's bit me on the ass the last month. but it wouldn't surprise me if they've got a surprise in store for us, right? The surprise won't be a surprise because we're so back and all of that happy horse shit. But you're never really you're never really ready to be all the way back until no one believes anymore. Like you have to really soil people's pants before we're so back. So it actually won't bother me a single shred. Uh, like I would love to just be able to stack strategy here until it moons. But I've been breathing a little bit of a sigh of relief because my portfolio on this rebound is back to a level where I'm like, okay, I could comfortably live. You know, even if strategy stays 182 forever, I could just sell covered calls on this and be all right. But man, like if I have to be prepared for strategy to go down 50% from here, whoo, that would be that would be a painful exercise. Luckily for me, I already got rid of all of my on paper margin. I'm still technically using margin because this crypto buying power is also the option buying power. And if strategy does what it did back on the last earnings and crashes like a mofo, where was that? February 5th? Yeah. Wait, all the way back. That was February 5th. Yeah, here we go. So strategy crashed like a mofo here. And I actually got a margin call because they changed their margin requirements. And they literally called me on the phone and they're like, we increased strategies margin requirement. I can't remember if it was to like 75 or 100% or something. And so that bumfuggled me right here. I had to. This is actually what caused me to sell some of my Tesla to cover that shortfall. I didn't want to panic sell my strategy at these prices. So, what was Tesla back then? On February 5th. Yeah. So, Tesla closed at 390. So, that wasn't actually a bad exit price to rotate out of some Tesla into strategy. But this is what made me, I kind of bumfuggled this, and I ended up not really even needing to fully sell those shares. Um, I could have probably just hedged them out with a buying a put and selling a call. That would have given me a net short position, and I didn't want to get hit with wash sale roll. So when I realized my mistake, I ended up putting together this synthetic position. I sold the put and bought a call. That gave me 100 delta long exposure. So I basically bought my, that was 40 days ago. I guess I didn't do that on February 5th, or maybe I realized my mistake shortly thereafter because this would be about end of March. Yeah, at some point I realized, damn it, I wanted more. I wanted my Tesla exposure back, so I put this together. Yeah, I think I didn't want to put that back on because I didn't want to get hit with wash sale roll on this bad boy. And I don't remember when I sold now this one. But that's why I did this in the first place. So with strategy, do I just hedge this out? What would it look like? If I hedge this out with a long put and a short call, 35 and 67 is about 102 delta. short position. That would actually be for a credit, and so it'd be for $1,000 credit. So I wouldn't get the 15 grand for selling the position, but it would increase my option buying power by about 4 grand. Huh. So I wouldn't be able to pay for the poor man's covered call doing it that way. The only way that I can get the full amount would be to just sell them. Hmm. All right. All right. So let's check the chats and see. What's up, Buffalo? What's up, OSX? What's going on, Colonel? Hey, what's up, AB? Who knew Tesla would have us doing actual moon math? Yeah, I just had like a 20-minute conversation with my brother-in-law, tell him about how I think Tesla's disrupting in the clear winter. And, you know, I was being generous that I said they're going to put all the gas car companies out of business by 2035. That'll probably happen before that, or get serious bailouts. See, Colonel says May 22nd is coming closer and strategy keeps rising. Still holding on to the 155s. Yeah, May 22nd. It's only 18 days away. Yeah, that's getting nerve wracking. The May 22nd 155s. What do I have? Yeah, and I basically am just looking at the extrinsic value. Like there's a decent amount of extrinsic value in those. Um, the 155s are slightly in a worse position than the 160s, but not much. So they're probably worth like 32, 32.50 or something. Oh, actually, you have a different date than I do too. That's May 22nd. So one less week. So they're probably about 3 grand. Let's just see what they are. Yeah, 31, 3050, 3100 maybe mid price. I wonder if I can squeeze the mid price in here. Oh, I'd have to get rid of one. I don't really use the in the money percent. I could add the mid price. All right. Yeah, so there's not a lot of there's like what, $300 worth of extrinsic in these bad boys. Is the extrinsic value in here? Oh yeah, so let's change this to extrinsic value. So there's $275 worth of extrinsic in here. That's only 2.5 weeks away. So that's about $100 a week. So if you hodl this for 2 more weeks, you can whittle the price of this down $100. To roll this out, you could roll the liquidity on 45 DTE kind of sucks. I think this one actually sucked too. Mid price would probably be around 34. So you could roll this out for about a $300 or $400 credit. Not the greatest extrinsic value, but you could probably, yeah, you might be able to roll to the 157 or the 160 and roll up 1 or 2 strikes and still be able to like get a slight credit or maybe a break even. That would buy you more time in like one or two strikes. But yeah, it definitely sucks. What's up, Sandeep? So much complacency with strategy. Would love to see a face ripping move to back to the 300s. Yeah, you just want your cash secured puts to be in the money or out of the money. But it helps us all. So I am also waiting for that rip. All right, so with that being said, plenty of extrinsic value here. No need to move this Tesla position. Same here. Got my few little shares of SATA hanging out. I'm probably, if I do trim some of these positions, I'll probably start building out some kind of SATA stretch position in this account. I don't really want sell in May and go away to screw the pooch. So I know it seems crazy to trim this position, but from the very beginning, I was going to enter the next cycle with no less than 1,000 shares. That was the plan. So I've got 1,100 here, and I think I've got another 1 to 200 in the IRA. So I could trim another couple hundred shares off this and still have 1,000 total. So that would still be fine. Plenty of extrinsic for 1 week, that is. This is a weekly. And then let's divide this by 10, 470 bucks. That's, man, having this column here is saving me a lot of time. Yeah, I may just hodl these for 3 more weeks and turn these into weeklies. If the price stays at 180, I won't be able to do that because this extrinsic value will collapse very quickly because this 80 delta will run very quickly into 90 delta territory. And once this gets over 90 delta, the extrinsic value is going to be slim to none. I've been talking about wanting to continue to add a bunch of long calls, but I may wait until June, July, August for those buying opportunities. Not saying that I'll get any buying opportunities, but if sell in May and go away is a thing, then at least this fits. I guess this is 100 delta worth of exposure as well. Well, it's net. It's net 24 delta now at this point because my covered call is so far in the money. But this and this adds up to 100 delta. And my short position, which was probably 50 delta when I opened it a few weeks ago, has spiked considerably, which is why Hermes rolls, between 30 and 40 days all the time to keep gamma risk at a minimum. I just put this cash secured put on, so that's doing well. I may take this off in May as well during my position trimming season. Maybe it's spring cleaning too. Does that fall into the spring cleaning? I never thought about that. Every year you do spring cleaning. Maybe every year you do spring cleaning for the portfolio. Hmm. All right, I put this on 3 days ago. It's already down almost to 50%, but I put this on for a week. So there's still four per. That can't be right. 1% of $50 is 50 cents. So there's 3% of the underlying price still in this option. It's crazy. All right, plenty to collect, even though I could take it off and keep almost half the premium. Yeah, and so all of May, I will be looking for opportunities to close and take off positions. And this one's only down about 40 cents, which is maybe a third of the premium in 2 weeks, but that's not terrible. Let me reshare without volume. All right, if I roll, why is it the 17 strikes? Oh, because there's no 16 and a half, so I'd have to roll this up. Or if I roll to 16, it's a much smaller credit. All right, 10 of them would give me 250 bucks. And that would only let me close like two of these things. Is that worth my time? Oh, wait. Oh, no, I've already got 40 of them at the 15. That would probably be for, yeah, that's not even for a credit. Um, maybe I maybe I kick the can down the road on these a little bit longer. I don't know. It is ready to go. Is today Monday? I say Monday. Yeah, if I roll these up now, since there's no 1650 strike, I would have to roll up a strike. And that's basically at the money. Yeah, I guess I'll wait. All right, nothing to do. Nothing to see here, folks. All right, the IRA is pretty simple. I got Tesla Strategy and Strive. Uh, you know what? This might be. Did I already take off a poor man's covered call in this account? Look at my activity. Yeah, I took off one. So maybe over the next 4 weeks, I'll take off like one of these a week if we're still in the 180 to 200 range. I can get a $5,000 credit for each one that I do, and I'll repurpose it into who knows what. All right, looks like I already rolled my 155s out to June 18th. and they're getting worse. There is extrinsic value in them, though, so I'll just sit on them like I do anything else. All right, nothing to do there. Did I already look at Tesla? Plenty of extrinsic value to collect. No rush on rolling this out. And then Strive. I already took off that poor man's covered call position and turned it into a Strive straight shares position. Let's see, 600 shares. I'm trying to unwind this covered call. That was like $2 in the money, I believe. Let's see. 280 of extrinsic divided by 6 is about 40 per, maybe 45 per contract, which is about 3% of the underlying price. So no reason to roll those early. And I got myself into a little bit of a predicament here. This does occasionally happen when people are running the wheel and they're on step 1 and step 2 on the same ticker. My covered call strikes are actually under my put strikes. So there's a chance that in the same week I could have these 600 shares called away if the price is 1575, and then be assigned 500 shares if the price is under 16. That's not an optimal position to be in, because this 50-cent window, I can lose both of these bets. It kind of ends up being a wash because I'd only lose 100 shares, but it is nice to have a sweet spot. If it was reversed and I had the 1550 puts and the 16 calls, then at 1575 all the puts would expire worthless, and so would all the covered calls. So this is like inverting the streams or something, or crossing the streams, I mean. All right, nothing to do there. Wolf, I had already rolled these out, so plenty of extrinsic value. Tesla's a long-term thing. Stretch and SATA are just backing up my cash secured puts. My maintenance excess is clean, so I don't have to take any of these positions off. Strategy long. This one's been on for 20 days. I must have been, was I just really aggressive with these when I rolled them to the 16? Because they've only collapsed in value 40 cents in 3 weeks. And it's funny because we have the $16 covered calls on Robinhood. My brother-in-law and I do. So we're kind of like worried about these getting called away in 2 weeks. Um, yeah, if I roll these even 3 weeks, I guess it's a 50-cent credit. That would put them back to the same price they were when I sold it. So actually, that's about right, I suppose. I didn't capture the 75 cents like I had hoped. But what's the bid-ask spread? The bid-ask spread is not terrible. All right, sure, why not? Partial fill. Better be a fill. All right, there we go. That gave me a little bit of cash, not much. 200 bucks. And we're still holding on by the seat of our pants to 16. So nothing to do there. And what's about to pay? I think Stretch is about to pay. So let's get one. Let's get one of each. I'll buy the dip on SATA. All right. Still holding on to 200 bucks of maintenance excess, which could evaporate pretty quick. All right. I like that spot. Okay. All right. The 5K account. I've got the Strive call, covered call at 1550. That one's getting wrecked. So that's a good problem to have. I'll just hodl that. The CLSK 12 and a half. Plenty of extrinsic in that one. This is the cipher covered call that expires in 9 days that we will have to. For max tax efficiency, I told them we could try to hold on to these shares for like a year, but that's like, it's going to be difficult. I would assume over the next year, Cipher runs hot in a very short order during some kind of 2 to 4 week period. I think it'll be hard to keep a hold of these things, but it might be fun to try. Now this one, we took off the Riot cash secured put that we had on. I think there was only like 10 to 20 cents left in that. And since it's kind of cool because even at Strive's price of 16, and I think Riot was trading at, I don't know, 18 or more, the 13 puts for Strive were paying a ton more. So I already had one, and I had him close the Riot 13 put and open it a Strive 13 put. We got paid like $1 instead of the 20 cents that we could have gotten Riot. Well, rolling it out, we could have gotten more. Riot. Yeah, the Riot 13 put we could have sold for 31. And Strive, we got like 90, 95 cents. It's nothing against Riot. It's just Riot's price is higher. So for ASST, it was much closer to the underlying price. But from a pure premium collection perspective, it's much more lucrative, as long as the price doesn't go in the shitter, to put the $1,300 of collateral up and get paid $90 versus Riot putting up $1,300 of collateral and only getting paid 30 bucks, getting basically 3 times the return. Now it's much more likely that Strive will crash to 10 than Riot crashes to 10, because Strive would only have to crash 650 to get there, and Riot would have to crash, what was it, $8. So there's a lot more breathing room in Riot, which makes sense, right? Take a bigger risk, you get paid a bigger premium. But that was the rationale for switching him over from Riot to Strive. And nothing else matters. I bought this one strategy share. What is the cost basis on this stupid thing? 166. So 20 bucks a share almost. Total return 18% or 10%, $18. Sometime this month, maybe I'll sell it and I don't know, do something with it. That'll do it for the day. Sandeep, no, they will just be $100. Oh shit! At 300, they'll be $100 out of the money. Good lord, man. Appreciate the tips. Just playing for time right now. Yeah, that's all you can really do. I mean, if you're hodling just a hodl, like, and there's no extrinsic value, then then playing for time doesn't do you any good. But since there's a little bit of extrinsic value, it's it's not bad. Um, but once all that extrinsic dries up, if that happens in the next week and there's no extrinsic value left, you don't have to hold it that last week. Just on general principle, you can roll it out, capture some more extrinsic, and then try to roll it up a couple strikes. Unfortunately, no option chain yet, but thinking about acquiring more Metaplanet shares. MNAV below 1. Expect it to pump once they release their public preferred share. Yeah, I only got a couple hundred shares, but I did send over $500 to my E-Trade account, and I should have done it all in one chunk. But I wanted to buy was it 220 shares? Yeah. I wanted to buy 220 shares because it was kind of silly, but numerically MTPLF I think was associated with the number 22, something like that. And I was like, all right, let me just get 220 shares. So I paid fucking E-Trade like $9, and then a month later I bought like I had like $50 left or something, and I was able to buy another 10, 20 shares or something. But I ended up paying $18 in E-Trade fees instead of paying it once. So that was kind of dumb. Almost there. Let's see. Metaplanet is supposed to be my hedge if I fuck up the covered calls. Not serving its purpose lately, though. Yeah, every time I think, oh, I'll have this and I'll use this to cover this, the pairs trade shit doesn't work out for me. So I feel your pain there. All right, that's it for today.